Silver is suggesting that gold should break to the upside. And, we've already seen a little bit of reversion in the gold-silver ratio. Hi, it's Mike Maloney coming to you from Phoenix once again. And Bullion Star posted that in 2011, silver ripped from $36 to $49 in 7 weeks. Back then, it was a retail frenzy. Today, it's structural failure, institutional awakening, and industrial scarcity. We're running a global silver deficit, burning through more than we mine. Demand is relentless. The math is simple. Structural shortage meets monetary debasement, and the smart money is just starting to notice. There was this chef named Emeril Lagasse, and he used to talk about kicking it up a notch. So I love these guys at Bullion Star. They are on the ball. But I'm going to try and kick this up a notch, and we're going to go to the January of 1980. So from the 11th to the 18th of January 1980, silver went from $36.60. That's this price down here. Now, we don't have candlesticks because stock charts only has the closing data. But in 1, 2, 3, 4, 5 days, it went to $49.45, and the intraday high on the Chicago Mercantile Exchange was $52.50. So from $36 to $52.50 in 5 days. Bam! That's kicking it up a notch. So, accounting errors cause LBMA to overstate silver holdings by 3,300 tons during March silver squeeze. And then Semper Vigilantes says, don't worry though, it's only plus or minus 100 million ounces that could be off. Oh, this is getting hilarious. Bullion Star again. Like I said, these guys are great. Listen to this quote. Britain's hoarding cash under the mattress. By the way, watch episode 7 of Hidden Secrets of Money if you want to see about hoarding cash under the mattress. Amid economic uncertainty, right instinct, wrong asset. And that's exactly what Hidden Secrets of Money episode 7 was about. Why hoard depreciating paper? Gold doesn't get printed into oblivion by desperate central banks. And here is the great quote. One asset survives monetary collapse, the other causes it. This is brilliant by Bullion Star. One asset survives monetary collapse, the other causes it. So moving on. Silver's great 50-year breakout begins, the 100-year flood, a cleansing most needed. I hope you're on board the silver arc. So I'm on board. Gold overtakes the euro as the second most held foreign reserve asset. Now, I want to reiterate, central banks do not hold Bitcoin. They hold gold and silver. They hold gold as a tier 1 asset, not silver. The U.S. dollar dominates, but falls to 58%, and that's down 10% in the past decade. Gold rises to 20%. The euro falls to just 16% of reserve assets. There's no cash available. The total market cap, percent of total market cap is like almost nothing. So all of these funds and stuff, they're holding no cash. And if you look at this, what happens is there's a crisis like the NASDAQ crash, and they move to cash. And then the subprime fiasco, 2008, 2007, 2008. COVID, they move to cash once there's a crisis. So it's best to either have something on the sidelines that you can make purchases with, or just be invested in real money. This is from Tavi Costa, Nick Laird, a lot of Nick Laird's data in here at Gold Charts R Us, and Incrementum AG, Ronnie Stoffele and his cohorts. And this is the dark line here, the blue line, is U.S. federal debt. And that's this scale on this side. This is the percent covered that the U.S. gold reserves covers of the U.S. debt. And in 1980, it rose to cover 16.7% of total outstanding U.S. debt. And today, that would require $23,000 gold. Now, all of the gold standards that we've had covered only the paper notes. Under the classical gold standard before the Federal Reserve, it covered the U.S. Treasury notes. Those were redeemable in gold. It did not cover bank deposits and things like that. It covered the actual dollars printed back then by the U.S. government, the Treasury. And then the intra-war gold standard, it was the Federal Reserve notes that were promising to pay gold, although it was a phony baloney, fractional reserve scheme with only 40% gold. And then the Bretton Woods system didn't make a specification as far as how much gold was to be in reserve, and only foreign central banks could redeem their dollars for gold. U.S. citizens were banned from redeeming their dollars in gold, and it fell to just 8%. But what would happen today if we decided that we were going to back all of the U.S. debt? That's another gold standard, basically. So it's within the realm of possibilities. I don't think it's going to happen, but this is just a mental exercise. What would happen if we decided to back all of our treasuries, the IOUs that the U.S. government has issued, with gold, saying these treasuries are redeemable in gold? What would the price have to be? Well, you go and get the total U.S. debt of $36,214 billion, and you divide that by the total amount of gold that we hold, 261.5 million ounces, and you come up with a price of almost $140,000 an ounce. That is how much debt that we have issued compared to the real assets that we have. $140,000 per ounce gold. It's not going to happen. I'm just saying. That's a mental exercise. So let's take a look at where gold is now, because there's a technical pattern that has developed that's rather important. If you take a look at this wedge pattern that is building, wedges usually break. If it's a symmetrical shaped wedge, it usually breaks in the direction of the previous trend, and that previous trend is up. So we've got this symmetrical wedge happening right now, and it's coming to a termination point. It can't get squeezed much more than it already has been squeezed, which suggests that a breakout is imminent from this pattern. So when you take a look at silver, let me see here, I need to go to a horizontal line, and there it is, and you can see this resistance that it busted through. Silver is suggesting that gold should break to the upside, and we've already seen a little bit of reversion in the gold-silver ratio. So this is the gold-silver ratio, and it was up above 100 again for just a few short weeks. It's back down to 92 right now. But let's take a look at this real quick. Again, a horizontal line, and we want to start it right at this 92 level that we're at, and you can see how rare this is. I mean, it's only a few times in history that silver has been this undervalued compared to gold. Where is it going to go? It's probably going to go somewhere down in this range eventually, and maybe even lower. So if we're talking about 20 to 1, and so here we are at 90 to 1. If you have silver now, or you change gold into silver now, and ride your silver, and then at 30 to 1, you go back to gold, you're going to get 3 times more gold than you paid for at this point. It could end up being 4 times or 5 times. I don't know where this is going to end, but in January of 1980, it was 14 ounces of silver to equal 1 ounce of gold. So that is the potential upside. Now, at GoldSilver.com, we've been showing this long-term chart for a long time. However, we have not updated it lately. This was done during the COVID era when it went into the 120s. It was in the hundreds just recently, but the average was 15.4 for a long, long time. And this goes back to 1687. But let's take a further look back in history. So if we go back to 3200 BC, it was 1 ounce of gold, 3 ounces of silver equaled 1 ounce of gold. then 9 ounces, 2 ounces, 10 ounces, 12 ounces, 15 ounces, 15 ounces, 8 ounces in 40 BC, 13 ounces, 11 ounces, 8 ounces in 1275 in Italy, 15 ounces, 10 ounces in Spain in 1497, in the year 1500 in Japan. 5 ounces of silver had the same value as 1 ounce of gold. 14, 10, 12, 15, 15, 105. Welcome to Clown World 2025. This is a meme that I forgot to use the last couple of videos for silver. I hope you enjoyed this video. Like it, thumbs up, subscribe. Everything that you can do helps. I want to thank you for watching. We'll see you next time.